Welcome to Friday. Today, I don't know what is today. Today is February 4th. Wow. So thanks for joining me today. We'll be going live very soon. And it's National Wear Red Day, so hence the red shirt. Got 2 minutes and we'll be ready to roll. Hope everybody's doing good out there. Had a good week. Ready for the weekend? I know I am. So today, we're going to talk a little bit about market volatility and ways to combat the craziness. Got a few different suggestions, and I hope you find it to be very beneficial. Can't see who's on here. Let's see for some reason. Well, whoever you are, hi. Well, there was 2. Now we're down to 1.
About 30 seconds, right?
Okay, I got 30 seconds. Ready to go. Hi, thanks for joining. Here we go. Hello everyone, hope you are doing well, feeling good, and keeping warm and dry. A lot of rain out there. Thank you for tuning in and spending some time with me today. I am glad you're here. You are listening to the Financial Chick Show, and I am the Financial Chick. My name is Denise Nostrom, the CEO and owner of Diversified Financial Solutions, a full-service independent financial planning firm located in Medford. Your Financial Chick is here to help you make better financial decisions and choices to improve your life and reduce your anxiety and stress about money. If you want to know more about me or my firm, you can always check out my website at financialchickshow.com. We are also on Facebook and Instagram at Diversified Financial Solutions, so like our pages to get updates and see what is happening. So I'm glad to be back this week. Last week I had to miss the show and do a replay of a former show. I will talk about the reason I was not here live last week at the end of the show. But if you did not have a chance to listen to the show from January 22nd, we're going to get it up on the web. Well, it's already up on the website, actually, financialchickshow.com. And we're going to try to get it on Facebook so people can see that. But it was a great interview with a client that has worked with me for over 25 years. She and her husband are the epitome of why using a financial advisor is so important. Of course, it takes two, but together we made all their goals happen one step at a time. I just had a Zoom meeting with them, their semi-annual client meeting this week, and they thanked me for all that I have done for them. This is why I love what I do and truly enjoy helping people do things that they can do, but they just need a little bit of help just to get them over the line. And that's what we did. So as I was actually I sent out a calendar to my clients, and on the calendar for January, Walt Disney's quote was there, and the quote said, "The way to get started is to quit talking and begin doing." So let me repeat that. The way to get started is to quit talking and begin doing. So that is what I do to help motivate my clients, my prospects, whatever the case may be. Right now, we're going into a very interesting period in the market. Everybody's been super confident. They get really confident when the market continues to go up year over year. Hey, you put money in, it goes up, everything looks great, you feel good. You feel like, you got a good handle of this. But let's face it, we have not seen a market correction in a while. Yeah, we had a few down years. The S&P 500 was down 0.73, so less than 1% in 2015, and it was down 6.24% in 2018. But many of us remember, I don't know if all my listeners remember, but it was pretty poignant, when the market was down 38.49%, and that was the S&P 500 in 2009. So, that might seem like ancient history now. We've had a lot of years under our belt of some good market performance, but things could be changing. People love to talk about investing in what I call, quote, the shiny things, like Bitcoin, cannabis, wind energy, solar, or electric vehicles. But let's face it, we would all love to get rich quick, but the chances of that are pretty slim. These are all great things, and I'm not against any of the things I just mentioned. If anything, maybe having anywhere between 5 or 10% of your portfolio. But what concerns me is the people that throw it all in, whether it be Bitcoin or solar or whatever the case may be, and just say, this is going to be my ticket. This is going to get me to retire that much quicker. So what I'm going to talk about today is basically, the tortoise and the hare, right? The tortoise takes its time, but gets to the same end game or end line just as the hare. So investing is a long-term goal, or investing for a long-term goal, like retirement, for example. It does take planning, it takes patience, and it takes discipline. However, market activity can cause investors, or all of us, to question their planning and investment decisions, which erodes their patience, makes them not as patient, and not as disciplined. So, we have been in a period of extreme market volatility for the past couple of weeks. I don't know if anybody saw, but this week was pretty volatile, but last week was insane. We had swings of 1,000 points in the market. It's an eye-opener to say that things are definitely changing. So, I'm going to talk to you is some tips about handling that volatility and making decisions based on facts as opposed to emotion. Now, we're all emotional people. I think most of our decisions we make, it's based on, how is it going to feel? Do we feel good about it? But that's why you work with a financial advisor, or you work with your doctor, or you work with anybody. It's good to get a second opinion and to find out exactly why you would do something or why you shouldn't do something. So I'm going to talk about a few concepts. And again, this is not to say, you need to be a specialist in any of this. That's why we're here. That's why I go to my guy to fix my car when the car breaks down. I don't want to do that stuff. It's just like you probably don't want to do a lot of these different things, but I'm going to give you these strategies and these tips to kind of help guide you when you're saying, man, what should I do? Should I do this? Should I sell? Should I buy? So let's talk about it. So the first thing is the power of long-term investing. So staying invested through a volatile market can be unsettling. It's nerve-wracking, like, oh my God, I'm going to lose everything. I have these goals. I want to do this. But one of the most difficult things for investors to do is to avoid panicking during a market downturn and selling stocks when they're at their lowest point. It's something that you want to do. You feel like it's the right thing to do. But savings requires a long-term approach, and those who stayed invested have historically been more likely to have stable returns over the long term. Now, you've probably heard about this, and you know, deep down in your soul, you know it's the right thing to do. But when the market's gyrating and it's going up, 900 points, and then the next day it's going down 1,000 points. Just look at Bitcoin. That thing's been all over the street. The bottom line is you want to stick with the things that are going to be there for the long term. There are reasons to sell in the short term, but the bottom line is that the stock market has always recovered. An investor who sees large stocks in the stock market, also known as a bear market, that's when the market's down, they know how unpleasant it can be, but history shows that the U.S. stocks have always recovered. So stay the course and invest for the long term. Because again, most of our goals are long term. We're not investing for the next week or the next month or the next year. And if you are doing that, you shouldn't. You should be staying in, cash position or in a money market. The market's just too volatile, even in a good year, to put all your money into the market for something like maybe buying a car in 6 months or a year. Don't do it. Just say no. The next thing is to diversify your portfolio to capture steadier returns. I have this awesome chart in my office that I use with my client meetings all the time. It's called the Callan periodic table of investment returns. And of course, I get more excited about this than my clients do. But what's interesting, when I do explain it to them, they like it too. But so just to give you an idea, last year in 2021, the best performing sector, I guess I'll give a little pause. Does anybody have an idea what they think it could be? So I will tell you, the best performing sector last year was large cap equity or large cap stocks, coming in at 28.71%. Conversely, the worst performing sector, again, little pause, what do you think? Well, the worst performing sector was global US bonds. Now again, and you probably go, well, I don't even have that in my portfolio. So that's one of the things you want to worry about too. You want to be diversified. But the bottom line is that if you diversify your portfolio, you're always going to have something that does well. So whether it be at the top of the Callan chart or the bottom of the Callan chart or somewhere in between, you want to make sure that you have a diversified portfolio. There's so many times I have clients come in or new people that come in and go, I am diversified. And then I look at their portfolio and they have like 3 large cap growth funds. It's not diversified. They have 3 funds, so they felt they were diversified, but they're funds that are going to do the exact same thing in the exact same market environment. So that's not what you want to do. You want to have some things going up, some things going down, so when you draw the line in between, you actually are doing well. So make sure that you have, there's a lot of different sectors. Real estate, you can look at international, which is a sector that I'm looking at this year. There's bonds, there's so many different things. You can even go into sectors, whether it be technology or healthcare. So diversification will smooth out the ride of this volatile market. So the next thing we're going to talk about is making contributions through market ups and downs. But before we do that, we're going to go to a commercial break. And when I come back, though, I have a lot of juicy information for you to kind of help you not be stressed during this crazy market volatility. So this is your financial chick, Denise Nostrom, the company's Diversified Financial Solutions. I help you look for financial solutions when you feel like there are none. So feel free to call me at 631-758-8691 if you have any questions. Let's take it to the break.
Two minutes, Denise, all right?
Okay, thank you. Okay, we got 2 minutes. So we're just doing a commercial break right now. I hope everybody's doing good, and hope you have some good plans for the weekend. And if not, I hope you relax this weekend. I think that's what I'm going to be doing, relaxing. So thank you for taking the time to stop by. Again, we're at a commercial break, and we'll be getting back live on the radio in a few. 1 more minute. This weather's killing me.
30 seconds.
Okay, thank you. We're back into it. Welcome back. This is Denise Nostrom, the Financial Chick. My company is in Medford, and you can reach me at 631-758-8691 or visit my website at financialchickshow.com. I'm here to help you on your financial journey. Over the years, things change, and I'm here to help you navigate all of those changes. So I'm tongue-tied. Today, we are talking about market volatility and some strategies to kind of help you smooth that ride, because it certainly has been a ride. So that's probably why I'm tongue-tied, because it's just been an interesting couple of weeks for sure. So we talked about the power of long-term investing. Very important. Volatility stinks, but you know what? If it's long-term investing, it's just part of the game. Diversify your portfolio to capture steadier returns. If you're diversified, you're not putting all your eggs in one basket. Corny phrase, but so true. If you have a lot of different things working for you, some things are going to be up, some things are going to be down. That's where you're going to go, right through the middle. Next thing, making contributions through markets ups and downs. So that's another really, really important thing. It's beautiful when you have a 401k, 403b, or if you're putting money away monthly into a mutual fund for whatever, buying a house or whatever they go for kids' education. The market, when it's volatile, is fantastic because, you know, if you're buying consistently, whether it be bi-weekly at work or weekly or monthly, whatever it may be, you're buying things at different prices. So making those contributions over time, instead of just putting money in today going, oh wow, I hope that this is a day that the market's low, you can, kind of average out your cost. You're going to buy it at different things and hopefully reduce your price over time. But another thing about making contributions during market ups and downs, a lot of times I hear from people, they say, what should I do? Should I stop putting into my 401k right now because the market's crazy? The answer would be a resounding no. That's actually the time that you want to do it. Think of it a bit about buying things that are inexpensive. So when the market's volatile or the market's down, that's the time you want to be able to get your money in there and you're buying more shares, which will benefit you down the line. So in a lot of ways, it's kind of contrary to what our beliefs are, but just keep it going. And again, if you have questions, call our office. When the markets are down, consider staying the course. This is another thing. So we talked about contributions, but now people say, okay, I'm in the market and the volatility is just making me crazy. I'm just going to take everything and move it into cash. This also is a very, very poor strategy. I'm not saying to kind of move, I'm doing this right now with my client base. We're taking accounts or investments that have done very well, peeling off some of those gains, kind of putting them aside, waiting for the market to kind of come down and take advantage of some of those low buying opportunities. But don't make big sweeps. Oh my God, I'm afraid, and I get out. I had a woman come to me. She didn't become a client, but that was okay. She had come to me and she said she sold out of everything based on a new administration in the White House, and she realized that was a big mistake because she didn't do well and the market did. So you don't want to do those types of things. You really want to make sure that you stay in the game and make little adjustments as you go. If it's long term, the short term is not going to matter. Take emotion out of investing. I kind of talked a little bit about that before, but it's so important. And there's another chart that I show to clients that I have in my office that is kind of like a wavy chart, and it says these are the things. So it's excitement, thrill, euphoria, and that's kind of the up part. And euphoria, that's when most people buy because they're so excited. They're like, oh my God, this mutual fund or this stock is up 50%. I got to get in now. Again, probably not the best time. So now we start going down and we look at, after euphoria, it goes to anxiety and then fear, and then it goes to capitulation and then despondency and then depression. And at that point where we're kind of going down the line, depression is where investors often sell. And that's the same type of thing as I was talking about before, that, you don't want to sell when it's down. And then we start going back up where we have hope and we have relief. and then we go back to the excitement. So again, it's a roller coaster of emotion that you don't want to get on. Go back to what your goals are, what it is that you want to do, what your time frame is, and just take the emotion out of investing, because you will fare so much better by doing it that way. Long-term investing is a marathon. It's not a sprint. Again, a lot of these concepts are very similar, but the market experiences a lot of ups and downs in the short term. But history has shown that over the long term, the longer you hold your investments, the less volatility there is. I always tell my clients the first year, you have a wide range. You could go very, very high your first year or very, very low. As you hold that investment over time, the highs become not as high and the lows don't become as low. So your bracket kind of tightens. So don't make all these movements. I was talking about this example of being on the LIE and you're behind a slow person. All right, so you want to get past them. But if you're a person that is going from this lane, the left lane, to the middle lane, to the right lane, and then back, and then, it's the same type of thing with investing. You're not going to get anywhere. And what's interesting is when you get further down the road, you usually see that person that's been whipping through every lane right next to you. So it's the same thing with investing. Just stick with it and don't make all these rash decisions in and out, because it never works to your benefit. Time in the market, not timing the market. Just kind of with that same last thing, but what I'll kind of say there is that there's never a great time to invest. There's always a great time to invest. Now that sounds weird, right? But we can never pick when it is the best time to invest, but it's always a great time to invest. It's just a matter of how you're going to do that. Right now, any new monies that are coming into the office, or people that are rolling over accounts or starting doing their Roth IRA, we're dollar cost averaging. We're going in slowly because we're giving ourselves the opportunity that if the market the market is volatile and it continues to be volatile, we're going to take advantage of those highs and lows. Why commit to investing today when the market might fall on Monday? Right? So there's, again, time in the market, not timing the market. We can't time the market. You really can't. But we can stay in the market and stick with our plan and follow our goals and do it that way. So it's just really putting success on your side. That's what we need to do. And bear markets should not scare you. It sounds terrible, right? Bull market, that sounds great. And bear market, not so good. But of course, bear market refers to the declining market, or in other words, when stock prices or assets are falling. And although bear markets are unsettling, they usually are short-lived, and they tend to be followed by longer periods of growth. So I find it exciting. I think it's awesome. It's kind of like, going to the mall or going to the supermarket and finding bargains. Like, who doesn't love that? Everybody loves to get things that are on sale or cheap. So when you have a bear market, it's a great time to invest. It's just a matter of the strategy, and that's why I'm here to help you do that, to get into the market. Finally, the last tip or strategy is when retirement is near, do not let fear derail your long-term strategy. Again, it seems like all the same words, right? But you're still in for the long term. A lot of times people say, oh, I'm like 5 years. Should I just put everything into bonds now? Like, I should really just kind of get out of the market. The resounding answer to that is typically no. Why would you do that? Because now, let's say you get into retirement. Even let's say you retire at 65. We have life expectancy to 85. So you could typically be in retirement for 20 years. So why would you want to get out of all of your growth when, look at what inflation's doing, recently. I mean, things are costing more. Just go to the supermarket, go to the get gas. It's all there. This is never going to change. So you definitely need growth in your portfolio over the long term. So stick with it. Don't run for the hills. There's not, this whole thing like, I'm close to retirement, so I need to do X, Y, Z. That game is over. It's really about what your situation is. And your situation is different from everybody, and that's why I meet with people. I'm not a one-size-fit-all financial advisor. Everybody gets personalized attention, and everybody gets a plan that's tailored to them. So I find that to be super important because everybody's situation is very different. So I hope these tips were helpful to you. So I'm going to go into my final thing, and I don't know if I'm going to make it through. I'm probably not going to make it through, but I was not here last week because I had to put my dog down. Here's the real part coming up. She was an amazing Jack Russell Terrier. Her name was Haley, and we were blessed to have her for 18 years and 7 months, which is like absolutely amazing. But definitely a piece of my heart is missing. My clients and I will definitely miss the office mascot so much. She was in there in the office every single day, so it's a big change. And I guess, what is that, Adele song? Go easy on me. But anyway, that's why. But I'm glad to be back and be with you today. And I thank you so much for tuning in. Again, this is the Financial Chick and the Financial Chick Show. And just remember, you can always do better and be better. So let's get together again next Friday. Sorry. That's why I waited to the end. I knew it wasn't going to be easy. Well, thank you so much. Take care. Have a good weekend.
You did that very well.